Have you ever bought because the RSI gave a buy signal but the price kept falling? Or maybe you waited for a moving average to confirm the trend, but by the time it did, most of the move was already over. Today I will introduce you to the Hull Moving Average, a lesser known indicator designed to react faster than a traditional EMA. Then we will combine it with the RSI to build a simple trading strategy. By the end of this lesson, you will know how to set it up, why it works, and the exact buy and sell rules you can use on your own charts. Stick around until the end for a quick quiz to test what you have learned. So let's get started. Before we begin today's lesson, let's reveal the answer to the quiz from the last video. The question was, which condition creates a valid buy setup in this strategy? The correct answer is B. A valid buy setup needs 3 confirmations. Price must be above the Kalman trend levels, showing an uptrend. Then price should pull back to a dynamic trend level instead of chasing the breakout. Finally, the RSI must cross back above the 50 level, confirming that bullish momentum is returning. When all 3 conditions line up, you have a much higher probability buy setup. If you got it right, great job. Now let's jump into today's lesson. What is the Hull Moving Average? First, let's add the Hull Moving Average to our chart. Go to the Indicators section and search for Hull Moving Average and add it to your chart. Now, open the settings and change the length to 55. Leave the rest of the settings as their default values. As you can see, it looks similar to an EMA. When the price is above the Hull Moving Average, the trend is considered bullish. When the price is below it, the trend is considered bearish. So, what makes the Hull Moving Average different from a traditional EMA? The biggest difference is lag. Now add an EMA with a 55 period setting and change its color to blue, then click OK. Now you'll see both moving averages on the chart. The yellow line is the Hull Moving Average and the blue line is the EMA. Notice that an uptrend starts here. The Hull Moving Average gives the signal much earlier than the EMA. A normal EMA follows the price, but it always reacts with a small delay because it's calculated from previous candles. When the market changes direction, the EMA needs time to catch up. Sometimes by the time it confirms the new trend, a large part of the move is already over. The Hull Moving Average was designed to reduce that delay while still keeping the line smooth. In many situations, it changes direction earlier than a traditional EMA, helping traders spot trend changes sooner. But remember, faster doesn't always mean better. In a sideways market, a faster indicator can also create more false signals. That's why we don't use the Hull Moving Average by itself. Instead, we will combine it with the RSI. The Hull Moving Average tells us the trend, while the RSI tells us when momentum is strong enough to enter a trade. Now let's add the RSI and see how these 2 indicators work together. Adding the RSI. Now let's add the second indicator, the Relative Strength Index or RSI. Go back to the Indicators section, search for RSI and add it to your chart. Now open the Indicator settings. Leave the RSI length at 14. Next, go to the Input tab, change the upper band to 50 and uncheck the other options because we won't need them for this strategy. For this setup, we will focus on one important RSI level, the 50 level. The 50 level works like a momentum balance line. When the RSI is above 50, it shows that buyers have a stronger momentum. When the RSI is below 50, it shows that sellers have a stronger momentum. However, we don't use the RSI 50 level alone to make a trade. The RSI becomes much more useful when we combine it with the trend information from the Hull Moving Average. The Hull Moving Average shows us the direction of the market. It helps us know whether we should look for buys or sells. The RSI shows us the strength of that move and helps us understand whether momentum is supporting the trend. By combining these 2 indicators, we can filter out many weak signals and focus on better trading opportunities. Now that both indicators are ready, let's put them together and build our first buy setup step by step. Buy setup. Now let's build our buy setup. The first rule is simple. The price must be above the Hull Moving Average. This tells us the market is an uptrend and we will only look for buying opportunities. Next, wait for a pullback. Don't buy after a large bullish candle. Instead, let the price slow down or pull back toward the Hull Moving Average. This gives you a better entry and helps you avoid chasing the market. Now look at the RSI. As the price pulls back, the RSI will often fall below the 50 level. That's completely normal. We are not looking to buy yet. We wait for the RSI to cross back above 50. This tells us that bullish momentum is returning and buyers may be taking control again. Once the RSI closes above 50, check the price one more time. If the price is still above the Hull Moving Average and the current candle closes bullish, you have a valid buy setup. Place your stop loss below the most recent swing low, and for your take profit, aim for the next resistance level or use a 1-to-2 risk-to-reward ratio. Remember, no strategy wins every trade. The goal is not to be right every time. The goal is to trade only when the trend and momentum agree. Now let's reverse these rules and build the sell setup. Sell setup. Now let's look at the sell setup. The rules are exactly the opposite. First, the price must be below the Hull Moving Average. This tells us the market is in a downtrend, so we will only look for selling opportunities. Next, wait for a pullback. Don't sell after a large bearish candle. Let the price move back toward the Hull Moving Average instead of chasing the move. Now check the RSI. As the price pulls back, the RSI will often move above the 50 level. Again, don't enter the trade yet. Wait for the RSI to cross back below 50. This shows that bearish momentum is returning and sellers may be taking control again. Before entering, make sure the price is still below the Hull Moving Average. If a bearish candle closes below the Hull Moving Average after the RSI crosses below 50, you have a valid sell setup. Place your stop loss above the most recent swing high, and for your take profit, aim for at least a 1-to-2 risk-to-reward ratio. As you see, the price goes down and hits the target perfectly. Common mistakes. Before you start using this strategy, let's look at some common mistakes traders make. The first mistake is using the strategy in a sideways market. When the Hull Moving Average is flat and the price keeps crossing above and below it, there is no clear trend. During these conditions, the RSI can also give weak signals. The second mistake is entering too late. Some traders wait for a very large candle after the RSI crosses 50, but by that time, a big part of the move may already be over. The third mistake is ignoring risk management. Even a good setup can fail. Always use a stop loss and manage your risk properly. Alright, that's it for today's lesson. Before we end, let's see how well you remember today's strategy with a quick quiz. Which part of the strategy is mainly responsible for identifying the trend? A. RSI. B. Candlestick pattern. C. Hull Moving Average. D. Volume. Leave your answer in the comments and let's see who got it right. I will reveal the correct answer in the first 30 seconds of my next video. If you enjoyed this lesson and want to learn more practical RSI strategies, consider subscribing so you don't miss the next one. Thanks for watching and I see you in the next video.